Thank you very much, Maddie. Welcome everyone to today's webinar. My name is Michael Hoos. I am out of the Raleigh office. I'm a director in our professional practices, and I mostly help engagement teams and do quality review and learning activities such as today. And we're happy also to have Andrew with us.
Thanks, Michael. My name is Andrew Taylor. I'm a director in our accounting advisory practice, and we assist clients with across the board, audit clients and non-audit clients with accounting standard adoption, with complicated transactions, and excited to meet all of you today and talk about CECL and give the overview of what needs to be considered this year for adoption. So on that note, I want to talk first around, today's agenda to get you all aligned on what we're going to talk about. Really five key things. Just give a high-level overview of what ASC 326 is, what it's all about. We'll talk a little bit about what's in scope. I'm going to cover down on what financial assets are in scope for everyone to consider, and then some of the key tenets or some of the key principles around how to consider CECL and what to think about as your company goes through its adoption process or consideration for CECL. We'll talk about some of the frameworks around that implementation. We'll talk a little bit about AFS, available for sale securities. Those are impacted not under 326 in terms of credit losses, but within the model itself, there are some changes to that standard around those instruments. And then we'll talk about some scoping and some key considerations around scoping for CECL. So first, I want to talk about an overview for 326, and I always like to start with setting a table around what's the standard entail, how does it differ from IFRS, and kind of what the backdrop was. So I'm not sure how many folks on the call were around in 2008. Obviously, that was some time ago, but as the outcome of the financial crisis that happened in 2008, there was a group called the FCAG, the Financial Crisis Advisory Group, that was formed, and their remit really was to create a single global model around credit losses. As with most things, IFRS and GAAP, that didn't happen, and today we've got two separate models. From the IFRS perspective, we've got what we call it a three-bucket model. They call it dual credit loss model, but there's different stages for credit risks in that model. You've got a 12-month loss estimation period. And then when you have a significant increase in default or credit risk, you've got more like, I'll call it a CECL type approach in stage 2. And then there's a stage 3 approach where credit impaired assets are deemed to be significant with write-offs that occur. On the FASB side, we have CECL, and it's quite frankly a lot simpler. It's just a single credit loss model. And that model requires that lifetime expected credit losses for all assets, not just those with significant increase in credit risk, are recognized when you record those assets in your financial statements. So, again, IFRS 3-stage bucket, US different. We've got 1 stage. So really, what 326 was intended to do was really intended to improve financial reporting by requiring earlier recognition, and the key there is earlier recognition, right? So when 2008 crisis occurred, people were asking questions about why didn't we know about these losses sooner? Why didn't we have visibility into what was going on with Lehman and other companies when that occurred? So 326 is really intended to require companies to have earlier recognition. It replaces the current incurred loss impairment model. That model there's a probable threshold, and this is a lot different. At inception with CECL, there's a lifetime expected credit loss that needs to be recognized. So there's really seven key tenets we want to outline today to give an overview of what CECL entails. So the first is, a lot of our clients come to us and say, hey, it's not in scope for us, or there's no impact for us. And Michael and I talk to those clients, and it's kind of like 606, right? Almost in a sense, if you guys recall Rev Rec, you have to do some sort of analysis on your what's in the scope, and Michael will get into that later in this webinar. But it's not just for banks. So corporate AR, note receivables, off balance sheet exposures, and we'll get into those more in a second. They're all in scope. So the bottom line is it's not just a standard for banks. It applies to all corporate entities. Auditors will want a scoping memo. Auditors want to know what you did to assess the impact of ASC 326. Tenet 2, trade and note receivables will be likely, for the most part, what's in scope for most companies if you're not a bank. Tenet 3 is estimating this credit losses over the asset's contractual term, right? So going back to that lifetime concept, what's the lifetime loss of that asset? Is it a 3-year note? Is it a 90-day receivable? Is it a funded or an unfunded off-balance sheet exposure? You have to go through the analysis to say, what's our lifetime expected exposure on that asset? And in general, the longer that exposure, right, a 3-year note or 5-year note, the more impact for credit losses. Think about that for a second. If you've got AR, it's 60 or 90 days. You probably don't have a lot of exposure due to the short-term nature of that collection cycle. But if you've got no receivable or funded or unfunded commitments, there could be a lot more credit risk there depending on the timing. Tenet 4 is really, this requires management to make new judgments. There's new policies and there's new processes that have to be in place. So, we tell our clients there's really 4 key areas here. You have to update your accounting policy for the adoption of 326. We believe that a scoping memo is also necessary to show the auditors, what's in scope for your company, for your entity. You've done a balance sheet analysis to say, okay, these 5 areas are in scope for us. Disclosures around CECL are also more robust. And on top of that, depending upon what you put in place for your loss estimates and the ongoing process, controls will also be a consideration for management when you adopt CECL. Tenet 5. So the estimate of credit losses is really around the past, 3 buckets. So the past, the current, and future. So, under the incurred loss model, most companies use historical estimates, historical losses to come up with what that incurred loss rate would be, whether it be 3%, 4%, 5%. Under the new model, under CECL, there's really that past component. There's also the consideration of, hey, what's going on currently in the current environment that would impact my estimate, and then also that future expectation. So what do I think could happen, or what are the key indicators that over the next 30, 60, 90, a year, 2 years that will impact my loss estimate? So it's just not saying, hey, last 5 years we recorded 4%. It's really more a robust consideration around what the company thinks is going on in the economic environment and what could happen, especially today, right? Think about, we had failures of recent banks, Silicon Valley. I don't want to use the R word, but the recession word has been thrown out there. So things are changing in the economy right now for a lot of us. So I think CECL is very important in the context of what's going on right now to get the estimates right. Tenet 6 is, like as I just mentioned, your historical losses will be your starting point. So, and it's not going to always be adjusted up. There could be things that you may see that may bring that estimate down. It's possible that you not only add to that estimate, but you could also bring it down. In Tenet 7, adjustments are made to your loss experience based upon several factors, right? So as I mentioned, there are asset specific factors, i.e. you've got AR, which is shorter dated. You could have AR in different countries where you've got different geographic risks. You could have note receivables, which are longer dated on the collection horizon. Also, as I mentioned, the economic conditions have to be considered. So, what could impact your receivables? Is there a correlation of CPI to what you expect to collect? Is there a correlation of unemployment or GDP? So it's looking at the things that, from an economic standpoint, that could happen today or in the future that could ultimately impact when and how much you collect on your assets. So put together a quick example just to illustrate what a company would potentially look at in terms of history, in terms of current, and then taking that current and adjusting it for reasonable and supportable forecasts. And again, this is just an example. So in this example, we have a company who had an ALLL rate, which was their historical losses, and that rate was 4%, right? So the historical loss rate, and in our example here is for AR related to electric motor sales for a major auto manufacturer. And this auto manufacturer had a 5-year loss history rate of 4%. So we knew that coming in, right? Their incurred loss rate was 4%. Now, CECL says, okay, we have that historical estimate. How do we adjust that? So we look at current conditions. So in this example, this company had a new product launch, and it's just only one small subset of AR, so it's not all their AR. They have a new electric motor segment for a startup company. So therefore, they don't have history on what the collection rate would be. They may not have all the data on what will impact their ultimate collection because it's new. On top of that, this company is starting up in a different geography. So you may have country risk. So in this case, we said, okay, well, we got a new business. We've got a company that's going to have sales in another country. So in this example, they took their historical loss rate of 4%. They added 1% for the fact that they're a new startup, and he added another 50 bips to say, okay, well, it's another country, maybe more risk, more timing lag to collect that AR from that company, and the estimate here ultimately changed from 4% to 5.5%. So just a basic framework in terms of understanding this history, current, and RNS forecasts as you apply CECL. Okay, with that, we'll go to polling question 1. The adoption of CECL will require which of the following? Consideration of historical losses, consideration of current information, application of forward-looking forecasted information, or all of the above. We'll give you all a few minutes to answer that, and then we'll show the results. Great. That was a very easy question, and 94% of everyone got that correct, which is all the above. So all those factors are a part of CECL. All right, so moving into the timing. So the timing of implementation, really, to sum it up, the time is now, right? So 2020, public filers adopted, the banks adopted, private companies and SRCs are this year. So as of January 1st this year, companies should have adopted. So hopefully everyone on the call, you're either in the process or are starting the adoption. And the first reporting period will be this calendar year end, if you're a calendar year filer. A couple of notes here. So as far as the adoption impact, it's a modified retrospective adjustment. So that is, to the extent you have changes, it's a debit to retained earnings, a credit to allowance. And as I mentioned before in a prior slide, I think auditors are going to expect that you've got some sort of scoping memo, and balance sheet impact assessment, and also an implementation memo. This question has come up from some of our clients, so I wanted to add a slide for this. So SRCs, if you're filing under 10F1 Reg SX, So you're an SRC if you've got public float of less than 250 million, or if you've got less than 100 million in annual revenues and no public float or public float less than 700 million. So it's important to note that it's not only this year for private companies, but also applies to SRCs. Okay, scope and core components. So talk about what's in scope. So basically we've got financial assets. Anything that's a financial asset measured at amortized cost is in scope, right? So as the guidance here shows, financing receivables are in scope, and we have a slide after this that talks more about those. Held to maturity, debt, securities are in scope. Oftentimes just have little credit risk, but technically they're in scope. Any receivable that results from revenue under 605, 606 or 610 is in scope. Also receivables that are related to repurchase agreements are technically in scope. I'm guessing there probably aren't many clients that are non-FS that have these, but to the extent that you have repurchase and there's collateral maintenance provisions, i.e. you've got cash covering those positions, there's an expedient that also takes those out of scope. One of the bigger ones here is lessors who have net investments in leases. They're in scope. So prior to 842, many companies didn't really classify the leases. They basically said, hey, if they're a lessor, they're all operating. That's what we've seen as a firm. So it's important to know that, you know, if you're a lessor and you've got sales type leases or direct financing leases, they're technically in scope. As I mentioned earlier, we've got off balance sheet credit exposures. You could have loan commitments, and whether those loan commitments, whether those are unfunded or funded, they're also in scope. And it's a matter of going through to say, you know, on unfunded pieces, what's the probability of funding? What's the probability of default? And similarly on the funded portion, what's the probability of default? So you can't ignore off balance sheet exposures. So that includes, you know, loan commitments, as I mentioned, standby letters of credit. They're also technically in scope. And then lastly, reinsurance recoverables. So these are amounts due from reinsurers for unpaid claims. These are also on the scope if you're a reinsurer. Going back to what I mentioned earlier on financing receivables, the examples here of financing receivables are loans, trade accounts, which Mike will delve more into, talk more detail around how those should be considered. Notes receivable. If you're a credit card company or you've got credit card receivables, they're in scope. And then, as I mentioned, the lease receivables, if they're sales type or direct financing leases. Just as any good standard that comes from the FASB would read, we've got instruments that are out of scope. So anything is fair value through net income is out of scope. AFS, different model, but technically out of scope for CECL. Loans for defined contribution employee benefit plans are out of scope. Policies for loan receivables, pledges for not-for-profit entities. And then, as I mentioned earlier with leases, if it's an operating lease, they're also out of scope for CECL. So other things that folks should be aware of, and these are, I don't want to call them one-off things, but they're not as common. PCD. So the standard replaces the concept of purchase credit impaired loans, PCI, with PCD. There are companies out there that buy known low credit quality portfolios with a very low expectation of collection. Those are in 326 with their own model, but not under the same model as notes receivable and AR, but just know they're in the scope. If you've got investees where you're the investor and it's under 326 or 323, you've got loan to that investee or an investment with those folks, they're also in the scope. And then preferred stock, meaning preferred stock from the investor standpoint, not the issuer standpoint, is also in scope for 326. And just an important, I just want to point out preferred shares, they can be debt or equity securities, but again, from a investor standpoint, if it's a debt security, it's in scope. So something to consider. It's probably a one-off, but we wanted to point that out. All right, so developing an estimate. So again, this is right from the codification. The allowance for credit losses evaluation account is deducted from the amortized cost basis. So basically, all this is saying is that once you have that transition entry, right, you debit debt expense, credit allowance, you made your adoption entry for any changes in your expected credit losses, that on an ongoing basis, that estimate has to be updated, right? So it's really important to get that correlation done properly. It's really important to think about how that estimate is generated, because each time you have a change quarterly or monthly, most likely quarterly, you're going to debit or credit that allowance in an expense account. So you don't want to create volatility in earnings. And so developing an estimate and what you think is going to happen is very important to make sure that things aren't going to bounce around in earnings. Kind of same thing here. So at each reporting date, you'll make that update to that estimate. So it's very importantly, I think that the writing here is apply consistently. So you make sure you align your approach early. You've got good controls over the estimate and those factors that drive your credit risk and your allowance, and consistency overall. As I mentioned, you want consistency in your estimate. You don't want your allowance bouncing all over the place, creating more volatility in earnings than you otherwise have. Okay, polling question 2. Which of the below instruments are in scope for CECL? We've got AR, notes receivable, credit card portfolios, or all the above. This should also be a pretty easy question for most of the participants. Okay, not quite a 94%, but yes, all the above, that is correct. With that, I will turn it over to Michael, who's going to walk through the core components of developing your estimate and then have some focus on AR.
Thank you, Andrew. And so yeah, we're gonna talk about the nitty gritty, kind of, how you would apply it to for most of you folks, which is probably gonna be trade-off for a lot of it for everyone. So these are the 5 components, or I would kind of almost consider them steps. With step 1 being that you need to group your assets into similar risk pools. This is something that's required in CECL with some caveats. Not everything has to belong to a risk pool, but you need to at least make that assessment. Step 2 would be, determine the method for your current expected credit loss model. There is no required method, but the standard does provide many examples, and we'll go over a few simplified methods commonly used for AR in a few slides here. Selecting the appropriate method is critical because the methods range in difficulty from easy to very complex, to the point that you need to use computer models. And what method you select will largely be determined by the type of financial asset and the data that is readily available to you. Step 3, you need to determine your historical loss experience. This is required as well. And for many entities, especially those that maybe haven't already been doing this, this will be the most difficult part of their adoption. And then step 4, you need to adjust the historical loss for current conditions and reasonable and supportable forecasts. Importantly, this analysis is required, but an adjustment to your historical loss experience might not always be required. In fact, it's quite possible, even likely, for some financial assets, perhaps AR, that an adjustment might not be necessary, but you still have to go through that analysis. As us auditors, and that's my basis. I started off as an auditor. Our famous saying is if you didn't document it, you didn't do it, right? So even though you might end up still using historical loss experience, you need to document how you got there. And then step 5 is, and this is something that's often overlooked. And some folks might be worried about, well, how am I going to come up with a reasonable, supportable forecast? We'll talk more about that and hopefully alleviate some of those concerns. But, if you get to a point where, hey, I could no longer support a forecast, 5 years in the future, only 2 years. And if you had financial assets that needed those, additional years where you don't have a reasonable supportable forecast, the standard allows you to revert back to historical loss experience. And so that's something that is sometimes overlooked and would help alleviate some concerns that some entities might have. So let's go over each of these steps a little bit in detail here. So step 1, grouping your assets into similar risk pools. Again, this is required with the caveat that not every asset will belong to a pool, and assets can move between pools. If an asset's risk characteristics change such that there's no longer shares similar risk characteristics with other assets in the pool, then that asset might move. Or if there are no other pools with similar risk characteristics, that asset would just be evaluated individually. For example, if a customer filed for bankruptcy, that receivable is unlikely to share any kind of risk with other receivables. It would be based upon the unique facts and circumstances of that particular client. And also, if that financial asset is evaluated on an individual basis, obviously you need to exclude that from your collective evaluation when you are evaluating that pool is a collection, as an aggregate. So CECL does not require any kind of specific method for pooling, but it does provide several examples. The one example that it doesn't provide that I included on here was aging. I've seen that. This is frequently the way that trade receivables will be pooled. They'll say that, obviously there's higher risk for something that is, greater than 120 days past due versus something that's current. And that'll be like the risk pools perhaps. But there's also other methods, right? Like collateral, for example, is this loan or asset collateralized? It could be by type of collateral, car versus home versus equipment. It could also be by asset to value ratio for that collateral. And then another method might be credit ratings, right? Those could be internal or external credit ratings. This is another method that's commonly used for trade receivables. So thus the asterisk next to the two that are commonly used for trade receivables. And then the other one could be, geographic location, for example. It could be that the geographic location of the borrower, or it could be of the lender. There's going to be different risk for different countries and different regions. They're going to have different ebbs and flows in their macroeconomic indicators. It can be by loan size, right? So the risk on a $100 million loan is going to be different probably than a $50,000 receivable. It could be the expected term, right? Obviously the shorter the term, the less inherent risk there is versus a longer term. You could be pooling them by the industry of the customer, right? Different industries are going to have different ebbs and flows in their economic indicators. And then, of course, you kind of a catch-all at the end here. You can use historical loss patterns. You can do essentially any way that you deem reasonable, right? And that's supportable. Some other ones that aren't on here, you do it by interest rate. Loans with higher interest rates would be riskier than lower. By vintage or year of origination, there'll be different underwriting standards in different years, or payment structures. Is it interest only? Is it principal? Periodic payments? Is it paid in kind? That kind of thing. So there's virtually unlimited ways that you could pool them. It's just that you're required to assess and then group and pool if there are financial assets that share similar risk. So after you've done that, the second step is you need to determine, what method you're going to use. Okay. Again, CECL does not require a specific methodology, nor does it limit methodology those that are provided in the standard, right? But it's worth going over some of the ones they provide in the standard. For example, the lifetime loss rate. Okay, and this method works by just calculating historical loss rate, importantly for each individual pool that you decide. And then you, of course, as we've been hammering home, or we're going to keep hammering home, you adjust that historical rate for current conditions and reasonable supportable forecast. For example, if you had a 1.5% historical loss rate on receivables of a certain pool, then that 1.5% is your starting point for determining your current expected credit loss rate. And so this is another method that's going to be commonly used for trade AR. Discounted cash flow, right? This method is usually applied to a single instrument, and it is good for financial assets that have scheduled cash flows, such as loans receivable. The allowance for credit loss would equal the difference between the carrying value and the present value of your future expected cash flows. The discount rate used would be the instrument's effective interest rate, not on a forecasted. And this method is far more precise. It's probably the most precise methodology, so that's one of its pros. But one of the cons is it's going to be very complex and time resource intensive. And it's going to require a lot of data analysis, and sometimes for a lot of entities that would employ this with perhaps a specialized software to do. Another method that is very common for trade AR is an aging schedule, right? And this is probably the most common one for trade AR. And essentially, it's very similar to the lifetime loss rate, where you calculate a historical loss rate. And we're going to go over an example of both of these, the loss rate and the aging, in a few slides here. But the difference in this one is that you apply this loss rate, you calculate it, and you apply it on an aging category versus an overall broad brush, if you will, right? So, to employ this method, you would have to, not only know historical write-offs, but when receivables were paid, so that you can properly put them into buckets that they reached. This is pro for this one's going to be, it's the most familiar to everyone. It's going to be more precise than the overall loss rate, but the con is that maybe it's not quite as precise as other methods. But I think also you'll find it a little surprising in how to calculate this. It's not as quite as intuitive as you might think when we go over our example. A few other ones are the vintage analysis. Again, this is where you kind of segregate your financial assets into their origination date or their vintage. And then on an annual basis, you determine what the loss rates were for each of the vintages. And then you apply that vintage loss rate. Year one, we lost 10%, year two, 5%, or whatever it might be. You apply that to the current outstanding balance. And of course, as we'll keep hammering, adjusting for current conditions, future forecasts, that kind of thing. Another couple ones, probability of default or the loss given rate. Conceptually, this is very simple. You're simply just doing math where you say the probability of default, PD, you have to define what default means. Is it, 30 days past due, 60, and you calculate the likelihood of loans entering that pool. And then you multiply that by the exposure, E, which is the value of the loan balance. And then you multiply that further by the loss given default rate, which is the percentage of exposure that is actually lost, right? So maybe you had $1 million balance, but you're only going to lose 200,000. That's your loss given default rate, and that technically is your allowance, right? But so it's simple in concept, but in practice, it's quite difficult because it requires a lot of analysis to get these three different variables, and of course to adjust them for current conditions and reasonable supportable forecast. And then the last one here is roll rate or the migration analysis. This is where you kind of track the credit quality of a pool over time and how it migrates from one pool to the next. And you measure a percentage of assets that will roll or migrate from one category to another. And then of course you apply that to, you know, your current aging and make adjustments for current conditions and reasonable supportable forecast. For most companies that maybe just have trade AR, I would expect to see most of them using lifetime loss rate or aging schedules, not some of these more complex ones. But again, at the end of the day, CECL does not say you have to use one method or another. It just gives some examples. So now that we've gone through and we've pooled our assets and we've determined our, you know, methodology, now it's time to calculate that historical loss experience. This is required. You can't just, you know, put a finger in the wind and say, I think it's 1.5% or whatever. I've had clients in my history who, you know, I've asked them, well, why is AR allowance, you know, 1%? And the answer is, well, we've always done it that way, you know. Well, that's no longer going to be acceptable. What we probably should always accept it is you have to do some sort of historical analysis. And now it's explicitly, you know, in the standard here. You know, for many entities that have not been analyzing their loss history, this is going to be the most difficult part. The CECL methodology that you choose will dictate how you calculate the historical loss experience, right? And when you're determining your historical loss experience, there's really two key things that you need to think about, right? Which is, what's the appropriate period to look at, right? It doesn't have to be the most recent period, and it doesn't even have to be sequential, right? For example, you might not want to select your loss history during the pandemic, because that might not be indicative of future performance. And then also you got to consider the length of the period that you're looking at, right? You know, for example, if you have financial assets that are 2 to 5 years of life to maturity, or when you think you're going to pay them, or they're going to be paid or written off, then, you know, you're probably going to want a commensurate amount of time of look back as well. And again, historical loss experience is just the starting point for developing the credit losses. You have to adjust them for your current conditions and future considerations, that kind of thing. I will say I've experienced this in some of my clients, for example, startups or ones that change business or have a new customer base. You know, if there is literally no history, then obviously you can't use your history. And so as a workaround, we've kind of used, you know, other similar public filers and taking a look at their loss rates is kind of our starting point. But most entities should have a historical experience that they should be able to use. It's just going to take some time to find that data. And then the other thing too, I'll say here is the two asterisks here. I think this is kind of the elephant in the room, which is like, okay, great, Michael, do it for current conditions and future considerations. How do I do that? You know, like the elephant in the room is twofold, which is, well, what are the factors that influence my credit loss experience, right? Is it unemployment? Is it, you know, credit rating? Who knows, right? Could be different for every entity. And then also, how do I quantify that, right? Like, you know, we'll talk about this a little bit, but, you know, the standard does not require the use of any kind of a mathematical model or anything like that. So, you know, information about current conditions and forecasts, it could be qualitative or it can be quantitative. You know, it can be from internal, external sources, a combination thereof. The use of specific economic indicators is not required. The standard doesn't say you must use unemployment or even say that you have to use an economic indicator when you're trying to judge how historical experience might be different than current and future. It's just that you consider information about current conditions and future forecast. You know, management does not have to do a mathematical analysis like a regression analysis to determine, you know, what's my correlation coefficient and how much does, you know, one change of 1% in this economic indicator impact my loss rate percentage. They don't have to do that kind of analysis. You can, but I would suspect for a lot of entities that are, you know, especially if it's just trade AR, you would not have to go through some, you know, complex mathematical analysis. And then the last step is, as I mentioned earlier, if you get to a point where you're like, hey, I don't have a reasonable supportable forecast past this date, then you would revert to your historical loss experience, and you can revert to that historical loss experience immediately when you don't have no longer a forecast, or You can do it, on a straight line basis. You can do it by input. For example, if you have a calculation when you have, 3 or 4 different economic indicators or 3 or 4 different things that you're using, one thing can revert back to historical experience because there's no forecast for that particular input and there is for others. So it can be however it needs. The standard is very open. It really just at the end of the day says you have to use historical and you got to adjust for current and future. And you got to support that. So, how does all this play out into practice, right? So, I would say, the initial scoping, go through your balance sheet by GL account number, outline those instruments that are in scope. And then for each instrument that is within scope, you got to do your risk segmentation, your pooling, right? Do all instruments share the same credit risk? Probably not. If they don't, then how are they different? For example, trade AR might require a segmentation by FICO score or by aging or customer type, that kind of thing. And then, develop your reasonable supportable forecast, document the historical approach, document how you're going to modify that for CECL, and then, develop that reasonable supportable forecast. Again, does not have to be a complex mathematical model, can be qualitative, judgmental. And then lastly, come up with your new estimate and your impact assessment. Adjust your previous allowance for the CECL considerations, do so by pool, and document your key considerations, your implementation process, and your change to accounting policy. And that's kind of a big overview of the steps and how it really kind of plays out. And now we're going to get into some examples, but first, we're going to go over our third polling question. And that is, which of the below are steps that companies should take to implement CECL? Group assets with similar risk, determine historical loss experience, update historical loss experience for current conditions and future reasonable and supportable forecasts, or all of the above. Give people a few minutes to do that. Hopefully we get a lot of responses here, so everyone gets their CPE and get some good answers here. Yep, 98%. So we have done our job so far, gentlemen and ladies. Okay, so yes, it's all of the above. Yeah, we'll keep hammering that home because that's the big message. So let's go over a few quick examples here. These are simplified examples, but we'll do them quickly here. Company ABC is a retail company that primarily sells products to individual customers, and they extend credit terms of net 60, and they expect you to collect or write off these receivables within 1 year. Company ABC experienced significantly higher write-offs during the pandemic and does not believe that its loss history during that period is indicative of future performance. And the company ABC has noted that write-offs significantly correlate with the unemployment rate, right? I put the asterisk there just to remind everyone it doesn't have to be a mathematical correlation coefficient or anything, it can just be management judgment. As the unemployment rate goes up, write-offs increase and vice versa. Company ABC has 10 million in receivables outstanding at period end. How would they calculate their AR allowance under the loss rate method? Well, the first thing is they would select a period. And here they say in the background, hey, we don't think that the pandemic was very indicative. So they selected a 5-year period prior to COVID. And they said, hey, we have 100 million in historical credit sales during that period, and we had 2.5 million in write-offs. Now, those write-offs would probably need to be analyzed to determine, if they really related to the 100 million in credit sales during that period or not. And then they would just, they would have simple math to calculate historical loss rate. Then they would say, hey, look, we believe the unemployment rate is what highly correlates with our collection history. And so they would, say, what's our unemployment rate during that historical look back period, right? In this case, we'll say 4.7%. They could do average, they could weight it, they can do it by geography. There's, a million different ways they can slice and dice this, but this is a simplified example. And then they would say, okay, hey, what's the current unemployment rate? What's the forecasted unemployment rate? That forecasted unemployment rate, if it's receivables and they think they're going to collect it within 1 year, they'd only forecast for that 1 year into the future, or 9 months, wherever they think is going to be the maturity date or the expected, repayment or write-off date. Right. And so then they would have a qualitative adjustment, right? In this case, they said, hey, it's less than the unemployment rate is lower than what it has been historically during the historical look back period. So we're gonna lower it by 50 basis points. Well, they could lower it on a nominal fixed amount, or they can lower it as a percentage of the prior unemployment or loss rate. It could be adjusted again without having to do any kind of mathematical analysis. It can be qualitative or judgmental. And then they would just simply apply that. The historical loss rate of 2.5% on the previous slide, less, 50 basis points, you got 2% estimated loss rate. And then they would just simply apply that to the current ending balance. And that would be a very high level, quick, loss rate method. It's, some of a simplified example. Now, if they were going to try to apply that to an aging analysis, right, we'll use the same fact pattern, but we're going to say, hey, we decided to use an aging methodology, right? So how would you calculate that? And this one, threw me for a little bit of a loop because I was anticipating it to be easier to do than I learned. So the first thing you do is you have to analyze when was cash received if you're going to use an aging analysis, right? So you would probably use the same, you should use the same aging categories or risk pools as you would for what the ending balance is at the current period. So you would use that same kind of pooling for your historical analysis. And then, as we talked about in the background, there's 100 million in sales, right, during this historical period. And we said, okay, well, if there's 100 million in sales, when did we collect, these monies? Well, we collected 40 million when it was only 0 days past due. And we collected 30 million when it was 1 to 30 days past due. And you can see here, it's just a simple roll forward depending upon when we get paid. And at the end, we say, well, we never got paid 2.5 million. Again, it's kind of similar fact pattern to the previous example. And then what they simply do is they're going to calculate the historical loss rate for each individual category, right? Aging category. So we use the same aging categories as the previous slide, and we start with the balance outstanding, and that is the 100 million was the beginning balance. If you recall from the previous slide, 40 million was paid before it became even 1 day overdue. So that means the past due balance would be the 60 million. And then 30 million, and so on and so forth, right? So it would be the straight from the slide before. And then here's the part that kind of threw me off a little bit. The write-off amount would be the same for each bucket, right? And then you would just calculate historical loss rate. I'll explain why the write-off amount would be the same for each bucket, even though you would think maybe it would only be applied to the greater than 90 days. And that is that if you think about it, the 100 million of credit sales, there's 2.5 million of losses in there, right? And then that 30 days later, well, after 40 million was paid, there's 60 million left, and there's still 2.5 million of that 60 million that never got paid, and so on and so forth. And so that's where you end up and why you use 2.5 million over each of the aging categories, right? And so you would simply then apply that to your ending AR balance. In this case, it's $10 million if you add it across, and you have your same buckets here, and you would simply take your historical loss rate for each bucket. You would make an adjustment, in this case, very simplified, 50 basis points downward, and then you come up with your expected loss rate for each bucket, right? This is the difference between the overall loss rate method. And then you calculate, simple math, what your expected losses are, and you come up with an allowance that, in this case, is significantly higher than your overall loss rate method. That's because this is far more precise than the overall loss rate method. So one of the most common questions that I'm sure a lot of you are thinking is, well, I don't have any loss history, so it's got to be zero. Well, the standard says that you should still do this even if that risk is remote. Remote's generally considered 10% or less. And so you would still have to apply this. The second bullet here, it does say in the standard that you're not required to measure expected credit losses if it's non-payment is zero, but that's kind of a very limited exception, and we're not expecting to see that a lot in practice. The example that they give in the standard is of U.S. Treasury bills, where even if they defaulted, it's a sovereign company or a country that can print their own money. And they say it doesn't have to only apply to U.S. Treasury bills, but the concept of there's no risk of non-payment because I can just print my own money, I guess unless you're auditing, monopoly or something, like at the end of the day, very few situations will it be that you're going to have non-payment is zero. So I would expect to have at least some allowance. Now, the interesting thing is that I have seen in my own experience that allowance amount might be immaterial, right? It might be that, hey, we calculated it, we went through all the hoops and have all our documentation, but we have a very low historical loss experience, and we think that our current loss experience, though it's not zero, is so immaterial. And I've seen that in practice a decent amount. So let's quickly talk here about the other change that Andrew mentioned, which is available for sale debt securities, okay? So there were targeted changes. Everything we've talked about so far is just your financial assets that are recorded at amortized cost, right? And that's the heart of the change for CECL. But the ASU that created CECL also did create some changes. ASU 2016-13. It did create some other changes, and the other changes are mostly for available for sale debt securities, right? And so the old legacy, other than temporary impairment loss model is gone, and now we have kind of a new requirement to identify impairment for available for sale debt securities on an individual security basis, right? And I got a flow chart that I think will really kind of help hit home how to do this and think about it. And the impairment is ultimately just going to be limited to the fair value of what that asset is. I'm going to go over the flow chart here. So the first thing you would think about when you're talking about available for sale debt securities is, well, is the fair value less than the amortized cost? If that's not the case, then there's no impairment, right? You probably have a gain. So you'd recognize your unrealized gain through OCI. But if you did have an impairment, fair value was less than the amortized cost, then you got to ask yourself, well, am I going to have to sell it? And this is pretty similar to the other than temporary loss impairment method. If I'm intending to sell it, or if there's a greater than 50% likelihood I'm going to have to sell it, if either of those are yes, then you would recognize an impairment, which would be the difference between the fair value and the advertised cost. You'd recognize that into income, and that would be your new basis, okay? But if you said, look, yeah, it's impaired, but I don't think I'm going to sell it or have to sell it, then the next step is, well, do you think some of the loss is due to credit losses, right? Is it due to the credit worthiness of the counterparty? And so you would recognize an allowance for that delta between the fair value and the amortized cost. But the important thing is you would bifurcate between the credit portion of the loss and the non-credit portion. And the credit portion of the loss would go into your income, and your non-credit portion would go to OCI. And then lastly, if you say, look, I don't think any of this impairment is due to credit loss, then simply there is no credit loss, and any kind of impairment would be recognized through your OCI. The last thing that I want to talk about for this kind of small niche change that ASU 2016-13 did was the standard says that you have to do this security by security, but it does say that similar securities can be grouped together. So it seems a little contradictory, but not quite. It says, for example, in the second sentence here, individual security levels means the level and method that you would aggregate and use by the reporting entity to measure your realized or unrealized gains or losses. So it gives the example of like a QSIP, common QSIP. That might be a way that you could group it. So when it says security by security, don't take that in a narrow sense, more of a broad sense. And with that, we're going to do our fourth polling question here. And that is, have you started the process of understanding and adopting the new CECL standard? Yes, I have a good understanding and have identified internal resources to assist in the adoption. Or yes, but I have yet to identify internal resources to assist. Or no, I don't have a good understanding. Or no, I'm still hoping there's another delay. And unfortunately, for those of you who are hanging your hat on D, I hate to break the news to you, I don't think there's going to be any more delays.
Yeah, I was just gonna say, Michael, I
Yeah.
don't think there's no more delays.
No, I think they're done with that. So give everyone just a couple seconds here to solve that. All right. Well, everyone's answered that one. So we're going to finish up a little bit with just talking about the disclosures, 2016-13 modified disclosures. Overall, an entity is just required to provide the information necessary to enable the readers to understand what management methodology is, what information they use. There's some general requirements. For public entities, I'll say that, in most public entities have already early adopted, but you got to disclose your amortized cost basis and current period gross write-offs. So that might be a little bit more complicated. I do have a brief example here from McKesson, which is a pharmaceutical distributor. What I would point to you is they literally in the second sentence just say the company estimates credit losses by basically repeating what's in the standard, considering historical credit losses, current economic environment, credit ratings, that kind of thing. So it's very high level for trade AR, at least in this situation. It can get quite complex, obviously, if you have more. Finally, I just want to say, the final takeaways are, if I had to boil CECL down into one, sentence, it's that, hey, you got to pool your assets according to similar risk characteristics, and then you have to look at your historical experience for those pools, and then apply adjustments for current and expected if deemed necessary. You have to at least consider that. For accounts receivable, they will be impacted. A zero loss history is not going to get you out of jail, so to speak. You're going to have to record that allowance on day one. Aging schedule analysis is permitted. We as a firm, we can help you with scoping and an adoption memo and to address many of these things that we've talked about. Your historical estimates, they must be adjusted for, current conditions and future forecasts. So care should be taken in doing that. And then ultimately, you're going to need to update the documentation of your accounting policies and such. And so that's kind of a big picture takeaway. Hopefully, CECL is not quite as scary as it was before this webinar. But I'm sure that everyone here can do it, or if not, we're happy to help you. And with that, I want to thank everyone on behalf of myself, Andrew, and thank you all for attending, and we appreciate it greatly.